the most important takeaway from many years of doing this is before you get started with an online brokerage, it's important, or before you give somebody your money, you should ask how you would get it back. And really thinking about, that day may come where you decide to move, what that might look like, because that's often a place where the fees start to hit. So if you're already unhappy in your relationship with a potential provider, it's going to make you even more unhappy to learn that that's really one of the places where fees stack up.
Hello, welcome to a new episode of Strictly Money, your go-to source for navigating your most important financial decisions. I'm Sejal Patel, and today we're going to delve into the world of self-directed investing. So if this is something that you are interested in, we're going to help guide you on picking the right one for you. You see, it's not just about fees, although fees are important. There's a lot more to consider. So let's jump into it. Joining me is Hamish Khamisa. He is the co-founder of Sparks Trading. Hi, Hamish. Great to have you on Strictly Money.
Hey, Sajel. Good to be back.
So you have been following this self-directed investment space for quite a while through Sparks Trading. This is a company that you started to help people pick the right one for them. Maybe start off by telling us why you started the business in the first place.
Yeah, that's an interesting place to start for sure. I, by training, am not in the financial or marketing world, but I come from a research background, and one of the things that I saw coming out of that research world that prompted me to get into this problem and this area in particular was just a real gap in the quality of information that people who wanted to take on investing on their own were encountering. So instead of maybe objective information, they were getting a lot of advertising and highly biased information. And another thing that really came out of my work in healthcare and research was looking at the importance of finances in older adulthood and how much that really plays a role in the quality of life that people can expect. And so the two of those things together in my own self-directed investor journey, made me take a look at what others might be facing. And I thought, well, this is an area where I can perhaps make an impact. And so that got me down the road. And what was really fascinating is just how little information there was that was unbiased or that was, easy to follow and digest, that was out there for people who are tasked with managing their own money. And I think that's what definitely set me down the road, and it brought me to where I am today.
Yeah, it's wonderful, Hamish, because we are vulnerable to marketing, obviously, and we don't know what we don't know. And, there's a lot of excitement, I feel, amongst investors to try to do it themselves, but obviously they have to be armed with the right information. So let me ask you, since you have been in this space and advising in this space for a while, what have you seen? How has it evolved in the last, let's just say, 5-10 years?
Yeah, it's funny to reflect that I've got that breadth of knowledge, but when you scale back along that time horizon, it's really interesting to see some of the longer term trends form. You don't necessarily see them form on a month by month or year by year basis. In particular, at the Canadian market for self-directed investors, things don't move as quickly as they do in the U.S. There have only been a handful of times over the course of this whole industry where things have moved rapidly, and that was driven by pricing. For example, let's say all the way back in 2014, so almost a decade ago now, where the commission rates dropped from $30 a trade down to 10, and that really caused a set of dominoes to fold in the industry. But from that decade perspective, there's really been attrition in investment and education. So a long time ago, self-directed in brokerages, back then we called them discount brokerages and online brokerages, they would invest time and resources in educating DIY investors. So they would have seminars, webinars, lots of great resources. Today, you don't really find too much of that. It's replaced maybe with blog content or the occasional newsletter, but nowhere near the kind of investment in building capacity and information and enabling investors to be able to make some smarter decisions around how they do investing. And that really was about the economics. So when commissions started going down, features and all of the additional things that maybe were present before got less investment. And now we're in a world where there are, commissions can be zero at certain brokerages. So you're not really paying a transactional price on executing a trade. But you're also not getting a lot of other features that come with paying for the service. So in a way, it's maybe you get what you pay for, is where you get what other people pay for. And not a lot of people are paying for commissions in this space. And so that's one big trend is sort of like a almost like an attrition or an erosion of investment in the client experience. And they've substituted with maybe like digital experience or, like design to try and make up for some of those content and educational pieces. Another really big trend is just there's, for DIY investors in particular, an expectation that things should cost as little as possible on the transactional front. And so, the move from desktop to mobile, we saw a lot of that in COVID, for example. That was a really big push when you saw retail investors flood into the market. But the takeaway is a lot of these online platforms are just not geared to be that agile. So you've got this underinvestment in the client experience from the education side. You have maybe like a minimal investment in how they're going to connect to the platform. And so there isn't this real sense of loyalty. There isn't a great excitement or energy. There isn't really like a sticky brand and relationship that these financial brands that deliver online brokerage services or connectivity to the stock market are providing to their clients. And so it feels pretty transactional at the end of the day. That's sort of the decade view.
So this is really interesting, right? Just that people, it's not sticky and there is no loyalty. Because the competitive landscape, Hamish, when I was looking it up, I think there's probably about 14 or so core, self-directed platforms. And, I was thinking about this. They're vying for I think, a small group of investors, right? Not everyone's investing. And for those who do, I would say, it's a small percentage that actually wants to do it themselves. So it makes me wonder what the outlook will be. I mean, what's the incentive for any platform or those behind the platform to invest?
Yeah, and that's a great question because there's this tension between these legacy systems, the amount of investment that would be required to make it pay back, and certainly if they're not charging on commissions, what are they charging on in order to recoup that investment? So that's a really good business question. On the other hand, there's still brands that are trying to figure out how to make the retail experience work in a commission-free world, and they're still coming to market to this point. So in January and even in November, so January this past year, November, late last year, two brands that have been around in North America and largely in the US market for more active investors. So Mumu and Webull are launched or have launched in Canada. So there is another brand in the UK, in Europe called Free Trade, which is taking waitlist spots right now in Canada. And so there are brands who are still trying to come to market. They're smaller and they kind of follow that Robinhood model, which we saw, and Simple Trade kind of tacked onto that as well. So there are brands that are trying to appeal to retail investors at the zero commission level and provide really great customer experience. So the impetus for the large incumbents to make a change is really, is there enough competition that we're worried about? And that comes back to what I was saying about the price erosion. What was really fascinating is that when National Bank Direct Brokerage, which is a recognizable brand in the bank tier, lowered their commission rates to zero, others other than Desjardins didn't really follow suit. And so, the large bank-owned brokerages, the big five, big six, they're not really forced to innovate by competition yet. And so they feel like they've got a pretty good handle with the relationships through their other products and services with the customer base, that they don't have to lower commission prices on this side of their business. And they definitely don't accelerate some of the client trading platform experiences that these newer brands are bringing to market. So it'll be interesting over the next, I would say like 2 to 3 years to see how these new brands take hold, because there's a lot of reluctance, I think, on the part of Canadian DIY investors to embrace some of these newer and sometimes foreign-owned brands, right? So these are two brands that I mentioned that might have U.S. affiliates, but are owned backed by maybe potential Chinese investment houses or that are based out of other parts of the world. So for Canadians to trust those financial brands that are handling their money and sensitive information, I don't know if that's also going to accelerate adoption and drive any kind of competition. But the competitors are still trying to come into the Canadian market, and it's not easy.
No, and it's not a big space, I would think. And you just need one big mistake to blow up. And you kind of saw this with Robinhood, and then the regulators crack down. You hit on something though, Hamish, and I think what would be interesting, just my view, is how the banks are looking at self-directed platforms, right? Because now I don't know, but from my experience, what I have seen is there are people who deal with advisors, and then they want to play. They want that little account where they can, manage their own money and just a little bit. And then you have the other side where it's someone new that's coming into this space and they don't necessarily have the funds to deal with a financial advisor. But they start off by doing something self-directed, and then they start moving along in the journey. And as their situation gets more complicated, that's when the bank can say, hey, you need more, maybe a full service type of advisory relationship.
Oh, yeah, that's spot on. I think it's fascinating because I had the chance to speak to a lot of different folks in industry while I've been covering this space. And I think they would characterize it in a very similar fashion. It depends sort of what size of online brokerage you're talking about. But let's say at the bank-owned brokerage level, what's really fascinating is that there's a lot of turnover in the management or the oversight. So the leadership isn't really there from beyond maybe like a 2 to 4 year cycle to drive some of this adoption and innovation and see it through to the end. There are brands, maybe let's say like Questrade, which has been around since 1999 and has had the same owner essentially since that time. Interactive Brokers, who you may know is a much larger sort of US based brand. Their founder is retired from the CEO chair, but is still very actively involved in representing and overseeing the business. And so when you get those, multi-decade kinds of leadership roles, you see the difference in how the brand evolves and how the relationship with customers is viewed. For the bank-owned brokerage, it's very much a tour of duty. So you see this turnover at the top and you see sort of things change. But what has maintained itself is sort of this view of maybe a transactional relationship with the customer, looking at self-directed investing, as a way into other products. So it's kind of an entry point into the network of other products and services. So it's not really viewed with the same lens as the managed wealth side. It's really, maybe it's to get the foot in the door and maybe get a chance to build a relationship with the client, have them appease the client to some degree. If, like you said, the wealthier clients want to have the capacity to do some of their own investing or dabble, they have that core and explore kind of language, then that's what drives some of the product launches at the bank-owned side. On the smaller side, though, with some of the smaller online brokers, and they view customer relationships somewhat differently, and they do try and cater a bit more to active traders. They will try and put in features in platform, for example, that will allow a more intensive or let's say a more enriching experience for their customers. But there's something that still stuck with me, and somebody said, and I won't kind of name names, but really the goal is trying to funnel people from the self-directed space into the managed products that they have in their portfolio. So to me, that's maybe the strategic lens that some of the leadership at regardless of size would try and see. So that's a complicated way of summarizing what you said, I suppose, but I can sort of point it back to specific brands that have said those kinds of things over the years, that this is really one of the reasons why they don't move as quickly, or where they're really trying to gain value as a financial service provider is on that manager advice side.
I think that's going to be really interesting. And just going back to the point around, financial education, if they are thinking about moving in investors to, say, managed products, and I'm not against that. I actually think, in many ways it's smart, because I see so many people trying to do it themselves, and they're not sophisticated enough to do, or they're too emotional to do it themselves. But it comes back then to say, they're going to have to educate people why this is smart. Hamish, we have a lot more to uncover. I want to talk now more about, how investors choose the platform for them. But we're going to take a short break and hear from our sponsors, BMO ETFs. So stay with us. We'll be right back. Welcome back. I'm here with Hamish Khamisa of Sparks Trading. Hamish, you touched on this a few times, fees, right? A lot of investors who are looking at self-directed platforms focus a lot on fees. And as you mentioned, most of the platforms have moved away from commissions and dropped them. I'm assuming it's because of, the competitive landscape. But let's not make any mistake. They have to make money, and they're making money somewhere. If it's not commissions, I have to think it's from somewhere. Can you talk about that? What are the fees? And maybe they're hidden and maybe they're not, but what are the fees that investors need to be aware of?
That's a great question. And, contextually, that's a place where a lot of people who are just coming into the markets, or who've been in there for a long time, don't really get a clear view of how things are priced. So traditionally, most people focus on the commission price. And while that is important, there are a lot of other places that online brokerage providers or financial service providers are very good at putting fees onto services. So probably the most important takeaway from many years of doing this is before you get started with an online brokerage, it's important, or before you give somebody your money, you should ask how you would get it back, and really thinking about what that day may come where you decide to move, what that might look like. Because that's often a place where the fees start to hit. So if you're already unhappy in your relationship with a potential provider, it's going to make you even more unhappy to learn that that's really one of the places where fees stack up.
These are the transfer out fees.
Exactly. They're called transfer out fees. Now, some of the good news is that if you're transferring out to a different provider, they can cover some of that.
They'll refund some of it.
Yeah, exactly. That's a good place to start, is just asking that question. If I choose to go somewhere else, what is it going to cost me? Or if I choose to get my money back, so if I'm withdrawing from certain accounts, what is it going to cost me? So if you need to withdraw from an RSP account, for example, or they don't do this with TFSAs anymore, but at one point they did, there's a withdrawal fee. There may be. Activity fees and minimum balances is another place that people tend to fall into a trap where there might be great incentives or promotions to get you into an account. They might say, oh, you only need to put in $5,000 or $10,000. But on the other hand, they might charge you, $25, $50 a quarter for not maintaining a minimum balance. And so that can actually add up. So for a good rule of thumb, anything under $25,000 at any account would be a good place to look a little deeper and see, are there any fees for inactivity, or are there any fees for minimum balance? Because if you're not at that $25,000 mark, Sometimes you can get an exemption because of your age. So the good news, and this is maybe one of those trends that is different now in this day and age than it was in 2014, but there are a lot of exemptions for younger investors, under 30, under 26, so depends how you define young, that really can offset some of those fees. But inactivity fees, so if you're not trading often, then if you're not bringing a minimum balance, then you're probably going to end up experiencing some of those hidden fees. So that in addition to commission would be the place that you would be looking at. And one other important note just on fees is there's some popular products that investors have drawn themselves into. So this is a high interest sort of savings kinds of products, and those are places that some brokerages support and some don't. So a good question to ask is whether or not what you're thinking of investing in is actually available at that particular brokerage. So not all securities are allowed to be traded at all brokerages, and that's something that if you hear through other investors, or you kind of see that's popular, you want to make some money with idle cash, you aren't always able to do that, especially at the bank-owned brokerage level.
Yeah, I think that's very important because not all products are offered everywhere, and I always say that to certainly the people that I teach is make sure you're checking those things. I thought the inactive fees was interesting too because there are a lot of investors who buy and hold. That's what we tell them to do, right? Create a diversified portfolio, and you don't really need to trade much. So that's something they need to watch out for.
Exactly. Yeah. If you're underneath those minimum balance thresholds, or you're trying to get some additional features, let's say like level 2 information, so like additional depth of market price, or you want to get some cool features in a trading platform. Those are neat features, and they are lots of information. Those are for more active investors. So the costs for those things are usually offset if you're trading more often. But if you're not trading and you want those nice features, you're going to end up having to pay as well. So the takeaway really is if you're underneath a certain balance threshold and you want to be that buy and hold investor, unless you're young. So there's sort of a gap you can see forming unless you're young or you have that money, then you're going to fall in a window where you're probably going to get hit with fees. And so that's a good place to think about who you would park your money with, because sometimes the requirements can be as low as $1,000 to keep in your account, or like even $250 to maintain in your account to avoid incurring any kind of fees. But for the big bank-owned brokerages, that level is much higher.
I'm glad you mentioned this because right now we're going into RSP season, if you call it that. There's typically not really a season, but it's still labeled as RSP season. And you're starting to see promos, right? There's a lot of people who are starting to throw money. Come with us, and we'll give you cash back or whatever it is. So I think this is very timely that we're having this conversation. Hamish, I want to get your views then on sort of those value add features. What are your thoughts on how important they are? Things like research or screener tools, for example.
Yeah, they're really handy. So they do cut down on a lot of time. And in particular, if you're thinking about most people who are at the stage where they're thinking about, investing, you mentioned, some products like ETFs, which are really popular. The screening tools for those help save a lot of time. There's a lot of those products now that weren't around in 2014 or 2015. We're just starting to come to market that really let you invest passively in a way that won't require you to look to mutual funds to do that. So you can get exposure to that. And I think that was the promise of the self-directed investing world. So now that's one of the nice things about being in 2024, and in particular for RSP season, is that if you want to get into those kinds of products, the tools that you'll need to navigate those kinds of products are really helpful. So screeners are really great. You don't necessarily need those dynamic price charts and dynamic price information tool sets. They're nice to have. There are some brokerages, just by virtue of their relationship with other exchanges, for example, that will pass through that level 1, level 2 dynamic information as part of a standard offering. I'll point to RBC Direct Investing, for example. They offer you some depth of market as part of your package. Some of those new brokerages that I mentioned that are coming to market are trying to entice people to join them. So like the Weebles and the Mumus, they offer those level 2, which is typically a very expensive feature to pay for on a monthly basis. You're looking at $40 to $60 a month sometimes for that kind of feature. And so they're able to bring that, as a hook. The promos and so forth, people are offering iPhones and, the thousands, they'll dangle like, oh, you can get hundreds or thousands of dollars for bringing over your business. Those are nice to haves, but I think the interesting part for people to really pay attention to is, what are the conditions that come with that? How long do you have to keep your money there? Again, I'd come back to, even if they want you to deposit a little amount of money, if you have to end up then incurring inactivity fees because you don't meet the minimum balance threshold, then you sort of erode that bonus that you would get. So it's not a bad strategy. There's a lot of conversation and excitement about the kinds of offers that are in market, especially this year. Like it's quite competitive in dollar terms this year and even last year compared to many years before that. So that's certainly where online brokerages are trying to push their efforts and their acquisition cost. But for DIY investors, the really important thing to know to navigate through RSP season and through all of these deals, which typically will start in November. So if anybody's sort of doing some forward planning, the kickoff is in November and it generally wraps up by the RSP contribution deadline date. So end of February, early March is kind of when things wrap up. But the important thing to really consider is, what conditions are attached to that. And choosing a broker just on a promotion alone is not a great strategy. But if you're planning on going with a specific brokerage, it helps tip the balance in one direction. It's nice to get something on the way in, especially if coming on the way out. But if you're starting, it's nice to get something on the way in that you can use towards, your own financial future.
Yeah. So you heard it here, everyone. Do your homework. It's not just about fees and it's not just about those iPhones and those gifts. Hamish, maybe just to sort of encapsulate it all, is there sort of one or two big mistakes that you see investors make over and over again?
There's a few. So yeah, one of the ones that I think maybe many people don't necessarily appreciate is that there are service gaps at all online brokerages. And one of the mistakes that I find people tend to make is getting really angry and then deciding to leave because of, an outage or, there's some service gap. They couldn't reach customer service in time. And, it's their right to sort of expect a certain level of service from their provider. But it's generally something that happens everywhere at some point, and picking it up and moving your business from one to the next isn't necessarily going to improve that over the long term. So that's one that I've seen play out many times over and over again. Another one is just that it takes time to do DIY investing. And, if people don't appreciate sort of how they want that portion of their their life. So you spend time worrying or, doing research and all that stuff. If you don't want to invest that time, then you have to kind of pick up a style of investing that matches how much time you have to do that kind of work. So that's a place where someone might have, good intentions to get into investing. They'll open an account, they'll put some money in, and then they don't go to it. And then those inactivity fees, or, it just sort of sits there idle and it's not necessarily making them anything. Like that's something that happens quite often, or they get intimidated and like, oh, I can't do this. And then things just don't go anywhere. So as I'm sure you've spoken to many guests, it's not timing the market, it's time in the market. So
in the market, yes.
How you are invested is maybe more important than trying to do it absolutely perfectly and all those things.
Yeah.
So over-engineering
great insight
is where I see people making the DIY mistakes.
Do you see consolidation in this space?
Yes. So we saw it with HSBC, and RBC. So the HSBC Invest Direct and RBC Direct Investing, like those are That's a small one. I think
And more, I guess, as a result of a bigger merger. But yeah, yeah.
exactly in the U.S. we saw it really with Schwab and Ameritrade. That was the really big cat. So there isn't a ton of competition at the U.S. side, but that's a really good canary for what could happen here. There aren't the competitive forces here in Canada that would drive that kind of movement. The value of the self-directed users is not high enough, I think, to prompt that. Even though there's, let's say between 14 and 19 online brokerages that are competing for market share here. They would probably just retreat from the market. So we saw that many years ago with Options Express and Schwab. They just decided, Canada wasn't for them. So they might just fold up shop as opposed to one bigger player trying to go after another. So there's maybe one or two brands now that are getting to the point where they've got these ancillary services. So they've got, in addition to the online brokerage, they'll have banking. They might have like a mortgage side to their business now. Those are places that a bigger bank could say like, yeah, we would want to fold that brand into our portfolio, or that would make sense. But consolidation, yeah, might come from we can't make it in this market, so we'll sell ourselves, or we'll exit this market, and someone will pick up that business. So that's what we saw happen. Virtual brokers picked up Options Express, and then CI Trading picked up virtual brokers. So there's a little bit, but it's not going to happen quickly. I think what we saw in the States play out was much more indicative of the seismic shift. There isn't a lot of competition at the online brokerage side anymore, and the players that are in there are really well entrenched. And I'd kind of maybe point to something like Interactive Brokers as a model where they represent one goalpost of a highly automated, technology-driven organization, and they've been able to really sway how different players in the market have to operate. On the other hand, you've got these large players, like the bank-owned brokerages, who just carry so much reputation and trust with their clients and with the general consumer awareness that they're able to continue on and charge a premium. So it's interesting, but I think inertia really takes over here. And so that's maybe my biggest takeaway, is that this space doesn't move very rapidly. And investors have expectations in other places where things do move more quickly. And that consumer sentiment is what might drive change more than anything else in this space.
Yeah, so we might not see a lot of disruptors, maybe. Hamish, really appreciate your time. Thank you so much for coming on. Now, I like to end the show by asking my guests 3 rapid fire questions, and it's just a way to be a little bit more personal and humanize finance. So, are you ready to play?
Yep.
Okay. What is the best financial advice you have ever received?
Probably the most sage advice is don't confuse trading with investing.
I think a lot of people get that mixed up. Mm-hmm. And it costs them problems. What is the worst financial advice you have received?
The worst financial advice, that's tricky, but I think the one that I would probably point to is buy and hold doesn't always work, right? And that's sort of when you conflate trading with investing. I think that's the expensive lesson that folks, and I've done it too, there's places where you've held and things end up going to zero. And if you're not paying attention to like the value side of it, because it's a value play, then if you don't watch it from a trading perspective, then it's going to end up statistically probably working against you.
Yeah, that's a really good one, right? Because when we see something go down, it's almost like we double down on that and hope that it goes up, and instead of cutting losses. And there's a lot of sort of behavioral finance research done on this, right? So that's a really good one. If you could impart one message to Canadians that you think would help them with their financial wellness journey, what would it be?
That's a great question. I think the thing that both as a self-directed investor and someone who's looked at all of this financial information over the span of time, the one thing that sticks out to me is that there's always a bull market somewhere, and that notion that value moves between asset classes is probably the most helpful piece of advice or like the most helpful insight that I remember reading many years ago to see how value flows. So it's not always in equities, it's not always in fixed income, it's not always in bonds. Like it moves. So there's a bull market somewhere, and I think if you remember that, then you're not always locked into thinking, I need to be in stocks all the time, or I need to be in bonds all the time, because it's not always going to be each of those different asset classes that are working at any one given time in the cycle. And that mindset really helps ensure that you ask yourself, like, do I have a good balance, or am I looking at the picture of the world that makes sense with my portfolio? And I think that to me is something that I found really insightful, because I didn't really hear it anywhere, and no one ever framed it that way. And I haven't really heard anybody frame it that way since. But
no, I really like the way you frame that, because it does come down to diversification, and I think people forget that, and home bias, right? Because like you said, there's a bull market somewhere, and it might not necessarily be in Canada right now, wherever it may be, but it could be somewhere else, and that just underscores the importance of diversification. And I also think, to your point, not hanging on, not being greedy. Because this is something I also learned is, when you see a stock rise, you don't want to sell at a profit. There's a lot of people who don't want to sell because they think, well, it's just going to keep going higher. And I keep telling them, I said, look, if you're disciplined, take that 20% return, lock in your profit, you will find another bullish stock somewhere.
Yeah, and if you're looking at it from a trader's point of view, you have to have a good set of rules and some discipline around what will get you out of a stock. And there are definitely strategies that can help you take money off the table. So you scale out of a position as opposed to just waiting for the exact top or waiting for the exact bottom, because that's incredibly difficult to do reliably. And then on the value side, if you're definitely in a situation where you're like, this is worth a lot more in the market than I paid for, you should also have your threshold set. And that's sort of, again, that's that, like you said, that tendency to want to try and pick exact tops and bottoms or try and extract the maximum value, be like, just
doesn't
perfect.
Work.
Yeah, it's hard to be reliable with that strategy for sure.
All right. Again, thank you so much, Hamish, for coming on. Loved our conversation.
It's a pleasure. Always happy to see you, Sejal.
Hamish Khamisa, co-founder of Sparks Trading. Don't forget to hit that subscribe button. You can find us on YouTube, Apple Podcasts, Spotify, or wherever you find your podcasts. We'll see you back here next week. Until then, stay well, stay wise, and stay wealthy.